their independence, and partly they can do that by being more transparent, explaining more fully exactly what they're doing, revealing more details from their balance sheets about exactly what they've done. So now we have the spectacle in the United States of Mr. Bernanke teaching university courses at George Washington University. I guess it's not a spectacle because he's an old university professor himself, teaching high school classes, giving speeches to all kinds of groups. That's the Fed's transparency offensive. They are trying to explain better not only that they're nice guys, but explain more fully the rationale for the actions they've taken, how it's consistent with their mandate, precisely in the effort to defend their independence. People complain in the US that all these interventions that the Fed and other central banks have been engaging in are storing up problems for the future, and maybe they are. They may be storing up risks of inflation, a disorderly bond market correction. They've encouraged, the ECB through its LTRO has encouraged European banks to load up on risky sovereign debt. Stock markets in the US may have gotten ahead of themselves. We may have more bubbles. We have complaints about currency warfare problems. I think all those complaints have some validity, but the point is for the Fed and other central banks not to do what they've done would be creating even bigger problems for the present. I think the trade-off has been, do you address grave problems in the present, or do you create potential problems for the future that hopefully you can address and resolve at a later date? And that's what the Fed has chosen to do. So that brings me to the currency issue. What does this imply for the dollar? And in order to talk about what all of this implies for the dollar, I have to talk about the alternatives to the dollar, insofar as there are any such alternatives as well. And the starting point for my doing so is the observation that our monetary and financial world rests almost entirely on the dollar. That foreign exchange markets are essentially markets in dollars. 85% of all foreign exchange trades worldwide are trades of other currencies for dollars. The Bank for International Settlements, which surveys foreign exchange traders, tells us this is true. 60% of all known foreign exchange reserves worldwide are US dollar denominated securities. 50% of all international debt securities are dollar denominated securities. 2/3 of all foreign bank funding, when commercial banks borrow in order to undertake investments offshore in someone else's currency, 2/3 of the time they're borrowing in dollars. So this is really an anomalous situation. Once upon a time, it made a lot of sense. The US was half of the economy of the free world after World War II. It made perfect sense that everybody did their international transactions in dollars. Now that the US is 20% of the world economy, that it makes sense is much less obvious. So that's why people have been predicting the end of this dollar-based global monetary and financial world for a long time. They've been predicting it on the grounds that, as I just said, the US is much less dominant economically than it was 50 years ago, that once upon a time it made perfect sense to do your international transactions in dollars. That's less obviously true today when the US is only 20% of the world economy. Once upon a time, it made perfect sense to do your international transactions in dollars because only the US had a deep and liquid financial market open to the rest of the world. Europe had capital controls all the way up to the early 1990s. Virtually everybody did in one form or another. Indeed, some economies still have controls and taxes on capital inflows. But the point is that there are lots of other economies in year 2012 that have liquid, reasonably liquid financial markets open to international investors. The United States and the dollar no longer possess a monopoly in terms of liquid financial markets. There's the argument that the dollar will remain dominant because it has the advantage of incumbency. Everybody uses dollars now, and nobody has an incentive to switch away. Because the dollar is the international financial standard, it makes perfect sense for you to use dollars in your international transactions, given that everybody else is currently doing the same. I would observe that this is the same argument that people made in the past about operating systems for personal computers and the like. Everybody has to use Windows as their operating system because everybody else uses Windows. Interchangeability costs are high. Windows is the standard that is convenient. If you want to exchange data and information with your coworkers or clients, you have to use the same operating system they do. That may have been true in the past, but it's not true now. We've learned how to build, they have learned how to build open standards for consumer electronics, and I think we're doing the same in financial markets, where the costs of comparing prices in different currencies, exchanging your investment holdings between different currencies are much lower than they were in the past. This one, to my mind, is key. People predict that there will be movement away from this dollar-based, dollar-dominated global monetary and financial system because U.S. fiscal capacity is less than it was once upon a time. So this is the issue of global liquidity that I referred to before. The global financial system requires a safe asset, a safe and liquid asset that people can hold in risky times. And U.S. Treasury bonds have historically been that safe asset. Why is that? Because the U.S. Treasury bond market is the single largest financial market in the world. It has unparalleled liquidity. Standardized assets are traded there. Its liquidity is guaranteed. It's backstopped by the Fed. But the problem is that the global economy is growing more quickly than the United States. We are a mature economy. Emerging markets ought to grow faster than mature economies as convergence occurs over time. But what that means is that as the U.S. accounts for a shrinking share of the world economy, our ability to provide these safe assets, to provide global liquidity, will increasingly be outstripped by the scale of a more rapidly growing world economy. There will have to be other sources of global liquidity if the liquidity that 21st century globalization needs is going to be provided. So the International Monetary Fund in this issue from 3 months ago of its Global Stability Report flagged exactly this issue. And finally, because the U.S. economy is challenged, because we have some issues that we haven't been able to address. In the short run, we have a growth issue. I'm worried about the U.S. economy at the moment because I don't see where the growth is going to come from. Retail spending, the recent retail spending numbers were very bad. Consumer confidence or expectations are deteriorating. We're a consumption-driven economy. Consumption is 2/3, as you know, of the U.S. economy. The consumer is on hold. Inventories have been rebuilt. Export growth is slowing, given that Europe is doing poorly and China is doing less well. The housing recovery may not be a recovery if you look at the latest existing home sales numbers. The Fed hasn't done much recently to support the economy. Households are still heavily indebted and trying to deleverage. So I've pretty much exhausted all the plausible sources of demand to support U.S. economic growth except one, and now I will go on and exhaust the last one. the last one being government spending. So what's happening at the moment is that the end of the 2009, 2010, 2011 Obama stimulus is occurring. Federal spending is returning to normal, and state and local spending is being cut violently because state and local revenues are doing very poorly. They depend on property taxes, which reflect housing prices, among other things. That's what's happening at the moment, and what will happen at the end of the year, as you know, is the fiscal cliff. So I don't know how many people are up on their U.S. fiscal cliff in this audience, but you will have noticed that two things are coinciding in the United States at the end of this year. One is we're having a presidential election, and the other one is that the Bush tax cuts finally expire. So if nothing is done before the election, which U.S. history suggests will be the case, and nothing is done by the lame duck Congress, the outgoing Congress that continues to sit between the election in November and January 20th, two things will happen on January 1st. Number one, the Bush tax cuts expire and taxes go up significantly. And number two, the process known as the sequester kicks in, where there occur automatic cuts in all non-entitlement spending by the U.S. government. So this will take something on the order of 3% of GDP out of the economy in 2013. Economists debate the size of the multiplier, but whatever you think the multiplier of fiscal policy is, negative fiscal impulse or shock of 3% of GDP is a big deal. So maybe the Congress and the next president will agree on doing the right thing. Mr. Obama would like to see the tax cuts, Bush tax cuts, retained except for the top 2% of the income distribution. And if that's done, that will mean a little bit more revenue, and the sequester can then be modified. The Republicans wouldn't like to see any of the above. So whether there can be a meeting of the minds, or whether it will look like the debt ceiling debate in August of 2011, stay tuned. But I'm deeply worried about how that will play out. All of that is about what will happen over the next year. People more regularly talk about the challenge that the U.S. Government faces over the medium term. We have structural budget deficits, and we have the possibility of explosive growth of our debt ratio. Every economist, every person in this room knows exactly what the U.S. has to do in order to solve that problem. Only three things: it needs to exercise expenditure restraint, where I think we've actually done pretty well. We need to raise more taxes. When I give this talk at home, I have to say, think about revenue enhancement. Instead, I have this graph here to tell my American audiences that the United States has some room to raise additional revenues. We are way down here as a relatively low tax economy. And we have to deal with explosive growth of Medicare, Medicaid, and healthcare costs more generally. Very simple in principle, very difficult in practice, because there isn't a widespread agreement on my diagnosis, despite how obvious the facts really are. And there's, even among those who might share the diagnosis, there's no agreement on what to do, for example, in terms of building the healthcare and bending the healthcare cost curve. So there are, I think there are very serious reasons to worry about the United States and the dollar, both in the short term, given a weakening economy and a looming fiscal cliff, and in the medium term, given our lack of demonstrated political capacity to deal with our structural budget deficit problems. So the dollar remains the only true global currency. There are a variety of reasons why